And bringing Chris Conway, he's from Australian Stock Report and joins us live out of our Melbourne studio. Chris, good afternoon to you. Welcome into the show. What do you make of the day's trade today, and in particular the push that metals and mining is giving the ASX 200?
Good afternoon, gents and Ingrid. Look, in terms of the materials push, I'm loving it. I bought BHP yesterday morning on the back of that market rumour about BP and Chevron poking around and slapping a price tag on the shale assets of between 7 and 9 billion, which if at 9 billion is probably towards the upper end of the range that people had been hoping for the sale price of those assets. So yeah, obviously I'm enjoying that today. And in terms of the broader market, everything Rudy was just talking about is absolutely true, and I don't disagree with it. And it's probably the reason why I'm more short-term focused rather than being a long-term investor. And I've just looked at sort of what Adam has been looking at lately, and the fact that the market, although the price action did slightly dip below 6,000, ultimately that level was defended, and we're getting a little trickle higher now and hopefully back towards 61.50.
Yeah, and another sort of, when you're talking metals and mining, a news we had in the last sort of 20 minutes or so is Fortescue, of course, looking to acquire a 15% stake or set to acquire a 15% stake in Atlas Iron at a price of 4 cents a share. Of course, this coming with them saying they're not intending to support the proposed scheme of arrangement between Atlas Iron and Mineral Resources. Rudy, I'll ask you about this one. Surprised by this move?
Yes, actually yes, but obviously it also indicates that that sector is in turmoil, and there's a lot moving plates there. I'm really surprised by. I might have maybe in the past underestimated the assets that Atlas Iron has, and I focused more on the fact that they have diluted their stake so much that there would never be a substantial upside from a few cents anymore. But definitely, well, the thing is that Fortescue obviously is now being confronted, contrary to their own expectations, with a permanent discount on their products. And they are obviously trying to find ways around that. And where they previously felt very comfortable in being an iron ore producer and being the number 4 in the sector, and possibly looking into other avenues like a lithium and things like that, now they're firmly focused on climbing up the value chain in iron ore. And
well, I think they have to, don't they? Really, they have to.
Well, I mean, it's either that or being stuck with a discount
to be
and then being
right?
exactly.
Yeah.
But
and so that blend would then make them or bring them up to closer
but
to
does,
Barley.
Does the Atlas Iron blend get them there?
Yeah,
I think it's the undeveloped. I think it's the undeveloped resource, and not the one they're currently. Right. I believe that's considered to be of high quality, but it hasn't been developed yet. And maybe that's where the interest comes from.
Chris, I don't know if you had time to get across it, but what do you make of a 15% stake? I mean, they already had, I think, about a 4% stake, because this has gone up to 19% now in terms of their total stake in Atlas Iron.
Yeah, so from my understanding, look, Atlas Iron actually has some quality assets. They just had a mountain of debt that they couldn't get out from under. And Fortescue wants those assets, and sort of to back up Rudy's point, yeah, they want that production and they need that production, but absolutely rightly, they need to close that gap from the 62% to the 58%. They just announced recently, of course, that they're bringing a new mine online. I think it's $1.5 billion of capex that they'll spend bringing that mine online, with the sole purpose of closing that gap to 60%. And I think the product will be called something like Fortescue Premium. So yeah, it all sort of makes sense. And look, it looks like they've taken advantage of an opportunity that presented, as I say, because Atlas was so far in debt that they could pick up those assets probably on the cheap a little bit.
Yeah, I mean, Adam, more broadly, what do you make of this move? I mean, you're saying it has to be done. I know, I'm sure Peter O'Connor from Shaw's all over it, but what's your take just initially?
Well, I mean, it's interesting. Obviously, they're paying a premium to where the share price opened today. The stock opened at 3.2 cents, so they're happy to pay a bit of a premium. Atlas Iron is, sort of tonnage being shipped. They're sort of 9 to 10 million tonnes. So we're not talking huge amounts of tonnage here. And Fortescue's what, at 155 million tonnes a year, somewhere around there. Yeah,
but again, I think it's about the undeveloped assets, not the ones there, not the ones there.
So I think it's a good strategic move, as Chris says. It's something that they need to do, and. Yeah, I think they're going to be they're cashed up. And they're going to continue to look to consolidate. And if they're at that 19%, they can't go any further. So they're going to have to creeping provisions or make a play for it.
All right.
And also, a caution here. We're talking here as if Fortescue is trying to. There is mineral resources in play, yeah.
Yeah.
I mean, mineral resources is not necessarily going to go to
And they're saying they won't support
have
that,
it,
right?
Have it, exactly. I mean, so this is actually a battle going on in the iron ore space, because Mineral Resources also want those assets for to strengthen their own operations in the sector. So it's not like Fortescue has the whole thing to themselves here. There's a battle going on here.
All right, I want to switch gears and go to Wesfarmers, the other big story we're watching today, Chris, because they're obviously holding their strategy day. There's been some various commentary from Rob Scott, but I guess all in all so far, how have you found it?
I don't think I'm taking as much out of it as perhaps some other people will. I think he was pretty clear in, wanting to remain patient, and that could either be code for the fact that they are looking aggressively for opportunities and there simply aren't any that meet their criteria at the moment. Or to pivot completely other way, they're throwing in a bit of a red herring and they've got something lined up, but they just don't want to let the market know about it just yet. So, yeah, look, like I said, I'm not taking too much out of it other than, there's just two speculative points that I raised there. Interesting to see them doubling their CapEx and OpEx in technology. I don't think it's surprising. When we look around the world, we see, institutions like the banks spending heavily on technology. So it's not unreasonable that Wesfarmers would be doing the same sort of thing. But pushing all of that aside, I like the patient approach. As an investor, I do like the fact that they're not in a great hurry to go out and spend, that huge amount of money that they've got on assets that would be subpar.
Well, here's what Rob Scott had to say on that a little earlier.
The most compelling opportunities that I see to generate superior returns from capital allocation reside in our existing businesses. And just to be really clear, we do not rely solely on M&A in order to deliver superior returns to shareholders. And in fact, to undertake M&A, I would say the outlook would need to be very compelling in order to justify investing a significant amount of capital on a significant investment.
What's your take, Adam, in terms of it being a long process, a once-in-a-decade takeover potentially is what they're looking at?
Look, they're certainly repositioning the portfolio, and I think that's that's what they need to do. The sale of the Cogra mine, the demerger of Coles, they're really sort of moving that, and then looking to establish that analytics centre, looking for that long-term value creation. I mean, we've heard that too many times through so many other companies. But I think, Wesfarmers, the market likes it. It's at 46 something today, which is above that sort of 10-year line trend where it's, it's been that 40, it's right on there, yeah? It's right at 46 and then back down to 40. So the market likes it. It is on its highs today. So what do I think about it? I think it's a good move. They're keeping the market informed. They're making some moves now for future growth. Yep. I think it's the right thing to do.
What do you think, Rudy?
I'm with Chris Conway on this one. The last thing they want, and you would be the same thing if you were in their position, only a few weeks ago, the share price in Fletcher Building just spiked on speculation that Wesfarmers might be looking. And then both Wesfarmers and Fletcher Building had to tell the market, listen guys, it's all speculation, there's nothing happening here. And Wesfarmers actually had to reject the speculation by explicitly saying, we're not interested. Yeah? The last thing that the Wesfarmers now wants is from assets in which they might be interested. They're going rally now because they've translated a message to the market that they are interested. So they don't want that to happen. They want to have their interest first and the market catching up later after they actually bought a stake or have come to an agreement. And I think that's the right tactic you have to do. You can't have the people now going look around and speculating on what asset you may or may not be interested in, because you will have to overpay them.
Yeah, Chris, we were talking with Steve Johnson from Forager earlier, and he was saying, look, really they should perhaps spin off Bunnings. What would you make of that move?
Yeah, I heard that as well. Look, to be perfectly frank, Ingrid, I haven't looked at that enough to understand what the upside would be. I mean, obviously they'd get a great price for it and it's a great business, but if it's such a great business, why wouldn't they just continue to hold on to it and reap the rewards from it? So, yeah, look, sorry, but I haven't looked at that one closely enough to make an informed comment.
Rudy, what do you think?
I think that's a bold call. I mean, but what you're basically saying...
Where would the growth come from?
Exactly, that's actually my point. I mean, the reason why, for example, a Fairfax had to sell its stake in Domain, which basically was the prime asset, is because they're in trouble. And that's usually what happens with companies that are in trouble. Orca had to spin off Dulux because they were in trouble. You normally don't sell your prime assets. I mean, that's the one you want to and that's the one you want to invest in, and that's the one that keeps the business afloat, that generates the cash, gives you growth and stuff. I mean, if they would sell that, the market would take that as a very negative, because they would go like, we don't want to stake in Officeworks. Right? We're all very cautious about what Officeworks will offer us in 5 to 10 years' time. Bunnings at the time, I know probably I haven't seen it, but maybe the reasoning here is that as the housing cycle slows down, and if you want to sell Bunnings, then maybe now is the time to do it and not wait 2 years. But I actually think, and I think all the messages that come from Wesfarmers have been to this extent, that they really like Bunnings, and that's their prime asset at this point in time. And I think when they are talking about we're gonna invest in growth in our existing businesses, I think they're more thinking Bunnings than they are Officeworks.
Adam, what do you think?
Well, yeah, I wouldn't see where the growth would come from, so I don't think that'd happen. But, again, just on a trading side, all-time high for Wesfarmers is 46.95. Currently stock is at 46.30. So, we're getting up there again to that level, and it'll be interesting to see if it can punch through that $47 mark, or it'll fall back. But at the moment, market's liking these announcements.
Let's even listen to Steve Johnson from Forager Funds and hear what his rationale behind it is.
It's just got its own management team, it's got its own culture, it's performing very well, and it's very large, and it would perform just as well as a standalone listed entity, and maybe even better. So I think when I look at that stable, it's the one that stands out to me as one that's actually not benefiting a lot from being owned by Wesfarmers.
So he's almost looking at it from the flip side, right, Rudy?
Yeah, but that's not the reason. I mean, what we're talking about is the board of Wesfarmers, and if there's no benefit for Wesfarmers, why would they do it?
So you don't think they would do it? You don't think it would be an option for them?
I don't think so.
Chris, in terms of Wesfarmers going forward, where do you see it heading? I guess with the Coles demerger in the works, FY19 is when they expect to split Coles from the business. How do you expect, I guess, Wesfarmers to look over the next 5 years?
That's the million-dollar question, Ingrid. And as we threw to Steve there in his clip from this morning, I was thinking about what Wesfarmers might be trying to do. So let's say, well, clearly they are going to sell off Coles. They'll keep 10 to 20% of it. Let's say they were to sell off Bunnings as well. Clearly they'd have a massive stockpile of money. And then, they're talking probably about acquisitions bigger than what we're thinking here at the moment in terms of the amount of money that they've got. So who knows? The CEO might have some very, very bold ambitions to become a huge player in some extravagant industry. None of us are ever going to pick that. So what it looks like, 2020 to 2025, your guess is as good as mine.
Quick thought on anything you're buying at the moment, Chris, before we let you go? Besides
I'll just give
BHP.
you one of the two that we bought BHP, as I said yesterday morning. Another one that we're looking at is Speedcast, which is a remote IT and communications player. Look, a lot of times clients have difficulty understanding this one. The best way I can sum it up is Carnival Cruise Lines. Basically, they give, as I said, IT and communication services in remote locations. I would assume a lot of people have been on a cruise liner. So when you're out there in the middle of the ocean getting your emails and stuff like that, that's what they do. Also has applications in the oil and gas industry, obviously maritime, government, and they have pretty sticky clients as well. So had a bit of a pullback recently in the share price, one we continue to like.
All right, Chris, we'll leave it there with you, but really appreciate your time as always on the program. Thank you.
Thanks, guys. Cheers.